Hi guys, so today I'm going to be showing us a reversal strategy that I use when trading, and it is called the head and shoulder pattern. So let me increase this font size. Let's say the head and shoulder pattern. Now we have the head and shoulder pattern, and we have the inverse head and shoulder pattern. All right, so the head and shoulder pattern usually look like this. This is your head and shoulder pattern. This is your head and shoulder pattern. Your head and shoulder pattern will look like this. Okay, my drawing might not be very perfect, but I think it's good enough. Now this is your inverse head and shoulder pattern. Okay, so this is your, reduce this. This is your shoulder, this is your head, and then this is your shoulder. This is why we call it the head and shoulder pattern. So in the same way, this becomes your shoulder. So we call this your left shoulder, left shoulder, right shoulder, and then you have your head. This all right, so this is, should I delete this? Let's delete this, delete this. Left and right. This is left, this is right. Okay, so you see, this is the head and shoulder pattern. This is the inverse head and shoulder pattern. Now take note, these are both reversal patterns. So you will normally see this form most times, for instance, when the market is on a downward trend, and then it forms the left shoulder, it goes down, it pulls back and forms the head, then you get a move to the top, it forms a right shoulder. Now this point is what we call the neckline. It's the neckline. This is the neckline, and this is your neckline. Now in most cases, the right shoulder and the left shoulder may not be equal, but it is the same pattern. So take note, we call this the neckline. This is the neckline, your left shoulder, your head, and your right shoulder. Now I said the inverse head and shoulder pattern is a reversal pattern. So the market's on a downward trend, and then it forms this pattern, and then the next thing you see in the market is that there is a push to the upside. The market switches from a bearish trend to a bullish trend, and then in a bullish market. It forms the left shoulder, forms the head, forms the right shoulder, and then the trend switches and becomes what? Bearish. So I'm going to show you an example of this on the chart and how I use this entry model. So this you can see this pattern on any of the time frames. On the 1 hour time frame, you can see it on the 5 minutes time frame, the 1 minute time frame, the 15 minutes time frame. You can also see it on the 30 minutes time frame, the 4 hours time frame. So the time frame you see it on is irrespective of the time frame, it can produce the same result. So for instance, if you look at this chart, we see the market, you know, on a downward trend from this point down to this point, but then we see what the market does here, downward trend from this point down to this point. Now the market got to this point and began to form let me use my head and shoulder tool. So the market came to this point and began to form something like this. So you see it from here, it forms something like this, something like this, something like this, like this, like this, like this. All right, so this is it. This is an inverse head and shoulder. So you see your left shoulder, your right shoulder, your head, and we're going to see. So now we see that the trend was bearish from this point down to this point. You see that down to the point where it began to form the inverse head and shoulder, and then we see all of a sudden a shift in the market, and the market reversed from this point, and you see a reversal in the trend. Now there are different ways you can trade this. You can simply decide to put your stop loss at the bottom of the right shoulder. Put your stop loss at the bottom of the right shoulder, and then you set your TP from this high here, from this high where the downward trend came from. So you see that it went straight to take profit. But personally, I will usually look for additional confluences to confirm that the market is going to continue in that trend, because the market can decide to sweep liquidity before pushing to the upside. But then in a case like this, you can see a clear. Now look at what the market did here. The market created a supply zone here. So you can see a clear supply zone. You can see another zone here. This is a clear demand zone. So on the right shoulder, the market created a demand zone. So we mark that demand zone, and then we watch what the market is going to do. So now you see on the right, from the right shoulder, it came and reacted at the supply zone, pushed market to the downside back to the demand zone, and then from the demand zone it pushed the market. So I use the inverse head and shoulder as a confirmation that the trend is about to shift, but I don't use it as my entry. So this confirms to me that the market is about to shift, and then I look for a valid demand zone from where I will wait for the market to come to before taking my trade to the upside. So you can see, so for me, I will take my trade from this demand zone. I put my stop loss below the demand zone. I put my stop loss below the demand zone, and then I trade it to this point, right? To this point. Okay, so that's a good buy setup there. Now you see that the uptrend continued till we got to this point. Now I'm not going to be talking about this today, but we saw that the market came to this point and created a double top. Now the double top here is a reversal indicator. It indicates that the structure is about to change, but that's not my focus for today. Now, having seen this, let's look at another example in the market. Let's see. Okay, I can see another one here. Now we see the market coming down from a downtrend, the market pulled up at this point, but I can see a clear inverse head and shoulder at this point. So you see that's an inverse head and shoulder at this point. Inverse head and shoulder at this point. Very interesting. At this point, so you see our neckline. Now normally you usually wait for the right shoulder to pull up back to that neckline before you know that it is a valid it validates that the reversal is going to take place. Now, so we see this here, it pulled up back to this neckline. Now, like I said, personally I would not take my trade in both cases. If we decide to place our stop loss here, we'll still make good profit with our stop loss under the right shoulder, and we trade it to the top here. That's a very good setup. And we can also see here also, if we were to place our stop loss here and target this position, we're also going to make good profit. But you always notice this on the right shoulder. Now you also notice the same way a demand zone was created here. If you look at this, it came to this point also, and it created a demand zone on the right shoulder, and then you can decide to wait for it to come back to that your demand zone before trading. Now you see the price pushed up, came down to this demand zone, went below and swept liquidity, pushed to the upside, came back and tapped our zone, and then the main move now began. So you can decide to buy from this position to the upside here, or this is very great move. So you see in this case the bearish trend came from this point. We can decide to take it from this point here, this supply zone, from this point, push the market down to this point and target this place as our profit. Now you can see how the market got to that position. So in both cases, these are clear examples of the inverse head and shoulder at work in the market. Let's look at the chart if we will see head and shoulder playing out in the market. Head and shoulder, head and shoulder for now. Okay, so that's that. So we'll stop here for now. Alright, so that's that for the inverse head and shoulder. Thank you very much and have a wonderful day.